It's been a tough couple of years for the Egyptian pound, leading to the current downward spiral.
The reason is that there is a scarcity in dollars because of a drop in tourism, as Russia and Ukraine account to over 38% of foreign visitors. Also, the higher prices of commodities after the Ukraine conflict and global inflation have pushed the import bill up by 8%.
This coincided with the exit of over $20 billion of hot money when the US Fed raised interest rates. In response, the central bank raised interests as well to keep the local currency afloat. The government is under pressure to devalue the Egyptian pound further if it wants to receive an IMF loan facility that it has requested to bridge its deficit gap. It's a repeat of the 2016 scenario, when the Egyptian pound had a free fall from £6 to the dollar to £18 and then reached 19.3 to the dollar, an all-time low, because of a $12 billion IMF loan program back then.
The International Monetary Fund has clear conditions in its structural programs. Having a fair price against the dollar without protection is essential for business. Not knowing the future currency rate prevents investors from planning ahead, so they are afraid to invest, and this leads to a recession. The pound has to be floated completely.
The government is reluctant to take that road, fearing inflation hikes would trigger public dissent. Some are calling for officials to seek an alternative strategy.
We should increase exports to increase dollar revenue, reduce imports, create self-sufficiency in some food commodities, and offer more incentives to attract foreign direct investments. All this will increase dollar supply.
However, global pressures could be too strong on the short term. Most financial institutions and analysts predict the Egyptian pound would plunge to a record 20 per dollar or beyond in the next year.